Before you watch the video excerpt for the CFE Technical Accounting Binder, I'd just like to say a few words about the videos. The PASS CFE Technical videos are a companion to the PASS CFE Technical Binder. In other words, they accompany the PASS CFE Technical Binder. The PASS CFE Technical Binder covers all 6 competencies that are tested on the CFE. And what we try very hard to do in this technical binder is provide a concise summary of the many topics you will need to know for the CFE at the level required to achieve competent on a CFE case. So we try not to tell you more or less than what you would need to know to get competent. What the PASS videos do is provide further clarification and discussion of the many topics covered in the binder for all of the 6 competencies. For some competencies, we provide cases in the binder. And the idea of the cases is to give you an opportunity to apply your technical knowledge to the types of case scenarios that could come up on a CFE case. The PASS videos provide take-ups of these cases in addition to providing lectures on the technical material. The PASS videos, as I mentioned a moment ago, cover all 6 competencies. The video that you're about to watch is one of about 40 videos provided for the financial accounting competency. We hope you enjoy the video.
We're going to start with revenue recognition. One could say it's the most important topic. Now, that's a bit of a funny comment on my part that it's the most important topic. Obviously, you have to know all the accounting topics and anything can be tested. But this is the only topic in financial accounting that I would say to you, I'm pretty much 100% certain will come up on the exam. I'm afraid to say that for any other topic. Even though there are other popular topics that appear a lot, I don't think I have the guts to basically say that any other topic for sure is going to come up every single exam. Revenue rec, the answer is it comes up every single exam. So again, there's other popular topics, but obviously this one is very big. And what happened a few years ago on this topic is they came out with a whole new section under Ifrs. That's already been a number of years. They've tested it several times already, at least twice, where I have the, at least twice going into September 2020, had it already come up under the new revenue rec section under Ifrs 15. ASPE did not change. ASPE is really old. Not that it matters. It doesn't stop them from testing it every single year, but I'm just telling you that ASPE is very old. Because Ifrs is so large, I used a lot of firm material to create this lecture. It's over 100 pages when printed. It's got to be one of the largest sections now, that Ifrs section. It's unbelievable. I mean, I don't even remember, God knows how many paragraphs. It's into the hundreds. So, you know, that's the reason it takes me a long time to go through it. I'm trying to summarize like a massive section. Might be the biggest. I'm not sure of. But if it's not the biggest, it's in the top 2 or 3 sections in the whole handbook. Because it's so large, I have to look at each one separately. I'm going to start with Ifrs 15, and then we'll go to then we'll go to 3400 ASPE, and that's going to take me less time. Okay. Any questions, comments before we begin? All right. Just stop me if you have any questions or anything as I'm going through this. I've divided up the section into 4 areas. I'm sorry? Oh, sorry, I missed the question. Okay. I'm not sure what the question was. All right. Again, okay. I have divided up the section into 4 areas. This is my division. The most important one is A. The second most important one is C. B would be number 3, and D would be number 4. Okay. So again, this is not a division in the section. This is my division. All right. I don't think the scope is that is that important? And some sections, I think it's more important. Actually, something we're going to do later today, PPE and investment properties, I think it's more important when we talk about the scope. For revenue rec, basically, it applies to everything, all contracts in all industries. There are a few exceptions, like who cares about insurance contracts? You never get tested on that. Okay, that's irrelevant. Okay, lease contracts, you're not going to look at this. You're going to look at leases. Same thing with financial instruments. So for a few sections, you have to look at the particular section. I don't think this is a big deal. I don't think anyone's getting too mixed up here. Non-monetary is a bit of an interesting one. It does not apply to non-monetary exchanges for companies in the same line of business. It does not apply there. Related parties also, okay, not such a big deal, but it does apply to related party transactions. All right, let's get into the first part, which is the 5 steps. So let me just say one thing up front. I found this a little strange when I was preparing this material, but I'm happy to say the exam, the CFE, is continuing with this oddity. What's the strange part? You're not going to see 5 steps in the handbook section the way that I'm going to lay it out here. And I'll be honest with you, I'm not sure exactly what happened here. I think when they were preparing this material, they prepared it in a way that they started off with the 5 steps in revenue recognition. All the firms, all the big firms, put out their material and based it on the 5 steps. But ultimately, when it came into the handbook, the 5 steps are there, but they're all spread out over the handbook, like over the section. So it's really weird. You would think that the section is going to talk about 5 steps, step 1, step 2. The answer is they don't. However, this is what all the material was. So I prepared the lecture based on the 5 steps. And then they started to test it in the CFE. And guess what? They're using the 5 steps. So that nobody's deviating from the handbook. Okay, that's not my point. No one's deviating from the handbook, doing something really different. It's just a little weird that I'm talking about 5 steps in revenue recognition. And when you look at the handbook, I'll show you kind of at the end, you start trying to track those 5 steps. They're there, but the order is just, I don't know, they're all over the place. It's not how the handbook was ultimately put, it's not how the handbook section was ultimately put out. Okay, whatever. Doesn't really matter. I'm just telling you this so nobody gets confused, but you should follow the 5 steps, and that's how they're testing it. Okay. Next point. The big word, is it here? Okay. The core principle is you recognize revenue when you transfer the promised goods or services. Okay. When do I transfer the promised goods and services? Essentially, the big buzzword is control. When you transfer control of the goods and services, that is when I recognize revenue. Okay, that's just a core principle for IFRS. That is not identical to ASPE. Anybody tell me the core principle in ASPE? What words would I use? 3 words in ASPE, slightly different.
Performance.
Okay, actually, one sec. Performance is good. I like performance. Wasn't the one I was thinking of, but you're right. That's a huge word in ASPE. Okay, when you perform the action, very good. Anyone else? Okay, excellent. Deep says, beautiful. Risks and rewards. Yeah. Now, people, risks and rewards are here under IFRS 2. They will come up in step 5. It is important. It's a little more important for ASPE. The big buzzword here, if you had to narrow down this entire section to one word, control. That's when you recognize revenue, when you pass control. Okay. All right, here are the 5 steps. Now, some of these are more likely to be tested. You want to know which ones are more likely? Now, obviously, any of them can come up. Okay, so I got to be careful here. Any of them could come up. But Some of them are a little more likely. Which ones are more likely? Step 2, step 4, step 5. It is what it is, okay? You still have to know step 1 and 3. I'm just telling you that if I had to place bets, step 2, 4, and 5 are a little more likely. Regardless, obviously, we're going to go through all 5 steps. You can get issues in any of them. All right, step number 1, identify the contract. Okay, so you want some issues for this. Identify the contract. Just some interesting things. A contract does not have to be in writing. Could be oral, but the parties have to be committed. Goods have to be identified. The third one is kind of interesting. Payment terms have to be identified. If you are totally unsure how you're going to be paid, and by unsure, I mean below 50%, you don't really know. You're not in the section. You're not in the section. You don't have a contract. You can forget the whole section of how to recognize revenue in this section. And the same thing with the last point. Okay, the contract has commercial substance. People, that term comes up in non-monetary. It's the same definition. Look at the last one. I know how my revenue's coming in. I'm just not sure it's going to come in. It's not probable, but what's probable? 51%. I'm taking a big risk. I hope I get paid. Under 50%, you're not in the section. So these are little issues that could come up. Realistically, you know why this step is not so common? Because that's one thing. If you're not in the section, then you're not going to have too much of a discussion. Okay, so if you're not in the section, you won't have too much of a discussion. So it's hard for them to test that. Now, if there's no issue here, someone is probably, yeah, if anyone is not muted here, I can probably mute you. Just give me 1 second. I think everybody is muted. Okay, everybody right now. Oh, who's not muted? Okay. Is everybody muted? Okay, I think everybody is muted. Okay, except for me. All right. What I was going to say is, everybody always asks this question: should I go through the 5 steps, even if there's no issue in one of the steps? I always say yes, because it's literally 1 sentence. How long will it take you in most of these cases, if there's no issue, to say, okay, we do have a contract and the goods are identified, step number 1, literally 1 to 2 sentences. So I can't get too excited about this. I just play it safe, identify the contract. If there's no issue, it will be a no-brainer. Like, it will literally be a no-brainer. It will be simple to do this. You can say it in 1 or 2 sentences and move on. It's not a big deal. Quite frankly, it's not worth arguing about. If you say to me, do I have to do this? I don't know. Probably, maybe not. Okay, maybe not. If there's no issue and identify the contract, can I still get competent without identifying the contract? Probably. I just like to play it safe because, again, it's like literally we're talking 1 sentence, just identify the contract. These are potential issues, what I'm showing you here. Okay, that's basically it. Oh, the last, yeah, look at this. So what do you do if probability is not, if collection is not probable? Well, you're not really in the section, don't recognize revenue. Any cash you get is unearned. And so could this change? Yeah, this could change. When you have no performance obligation, then you can recognize the rest of the revenue. Okay, it's not refundable, it's mine. Or if the contract is terminated, okay, fine, then you can recognize the revenue. Okay, so this is basically fine what you would do if the collection is not probable. So like I'm saying, I think this is less of a probability for this type of stuff to come up. It's not so big. Here's another little issue that they could get into. This actually could come up. If I enter into 2 contracts around the same time, the issue is, should I account separately for each contract or as one contract, even though there's really legally 2 contracts? So they give you 3 rules, 3, I don't know, rules of guidance. If it's a package, if the amount in one contract depends on the other contract, if it's all one performance obligation. So it's possible they could do something like this. They could give you, I guess, multiple contracts. And you'd have to figure out, do I look at each separately? If I look at each separately, I have a separate revenue rec discussion for each. If I look at them together, I don't. These are some of the rules. You'd have to use your judgment. So this is another little issue they could do around the contract. I've not seen this come up yet. But again, people, bear in mind one thing. I have to be a little careful here. We don't have a huge history on the CFE on revenue rec for IFRS with this new section. It is what it is. Okay, we don't have that many years. As I said, I've got 2 years, and as at the time of this recording, I've not seen September 2020. Maybe that'll be 3 years. I don't know. I haven't seen it. Okay, so I'm just saying we don't have that much. We don't have that much history. I can't help it. The section is only from, I don't know, when did it come out? 16? No, when did it come out? 18 or 19? I don't know, something like that around then. So we don't have a huge history here. So just keep that in mind. Anything I tell you that has already shown up, I'm not dealing with like a 5 or 10 year of history. All right, people, any questions? That's step number 1. Step number 2, probably more important. This has come up in the little history we have. This, of course, has come up. Step number 2, identify the performance obligations. What are the performance obligations? That's what you're selling. It's the goods or the services. All right. Now, people, you know what the whole issue here is in very simple terms? Do I have one performance obligation or do I have more than one? Why do I care? Because if you have more than one, I need more than one revenue recognition discussion. Think about that for a second. If you have one performance obligation, you discuss, okay, one product, revenue rec, you're in the section, go through the 5 steps. But if you have 2 performance obligations, and they're different, distinct, we'll talk in a second. You have 2. I need 2 revenue rec discussions. I need 5 steps for each. I now need 10 steps. So that's a big thing. Step number 2. So how do I know if I have 1 or 2 or 1 or more? That's the question. So the handbook gives guidance. The handbook says, well, they have to either be distinct, so you can break them out, or maybe you have 2, but they're substantially the same, so we'll look at them all together. All right, what is distinct? So this is important. It's capable of being distinct. What does that mean? The customer can benefit from the goods or services on its own, or with other resources. Okay, and it's identifiable in the contract. In the contract, it's identifiable. It's not highly dependent. It's not interrelated. The more interrelated product A is with product B, the more likely it's not distinct. The more separate it is, the more likely it is distinct. Okay. So, people, this is important, and the handbook gives a decent amount of guidance on this. So look at these questions, people. These are important questions. This is what you would do in the question. You would analyze these questions. You have to. It's a judgment call. Are the goods integrated? And you know the answer. Which way I'm going here? If you say yes, that sounds like I've got 1. If you say no, that sounds like more than 1. Does one good modify another good? If you say yes, it sounds integrated. Are they interdependent? Does one depend on another? Can the company produce one and not the other? If you say yes, it sounds like they're separate. So for all three of these, if you say no, they're not integrated. One product does not modify the other. They're not interdependent. If you say no, that sounds like they're distinct. And if you say yes, the implication is they're not distinct. So look at this. This is a crazy amount of guidance I'm giving you here. It's all in the handbook. You don't like the previous page? You don't like the previous slide? So do A, B, C, and D. That's another way of looking. I mean, some of the points are the same. So this is important. I'm not saying for sure this comes up. People, they could just give you a revenue rec around one issue. Okay, fine. You don't even have step number 2, and you just explain there's only one product. That's all. Or sorry, say the words performance obligation. Okay, so okay, again, I would do step number 2. Yes, I would do every step. But again, if there's no issue, there's no issue. Fine. You don't have to. Please don't start making up a whole discussion. Just say there's one performance obligation. All right, everyone good? So it's a judgment call. At the end, it's a judgment call. Let me give you a couple of examples, because again, this could be a big issue. Let me give you a couple of examples. I got a plane. The plane, a manufacturer of planes. They're selling a plane, and the kitchen's in the plane. Okay. When a plane is purchased, is the kitchen in the plane distinct? Well, is it distinct? I don't know. Let's see. Could the kitchen be sold separately? Yeah, but it's not. I sell the plane with the kitchen. It's not really identified separately. What does that mean to sell separately? Well, I don't know. If somebody hired me, I guess I could go in and produce a kitchen in a plane. But the reality is I'm selling the plane. I'm not breaking it out. I'm including the kitchen. So in this case, no, it would all be looked at as one performance obligation. All right. Everyone good? Second issue. Second issue. Still second step. Second issue. How are you performing the obligation? Are you doing it over time? Or are you doing it all at once? Okay. So look at the example here. I don't know. A manufacturer of a house subcontracts out some of the construction. This happens all the time. Should they treat the product, the performance obligation, as one, or because they subcontract out, should they start dividing it up? So again, we look at our criteria. In order for distinct, the subcontracting services are obtained elsewhere. Okay, that's true. The subcontracting services, I hire someone to put in the steps. I hire a third-party contractor to, build the mirrors in the house. Okay. Are they all being integrated? Yes, they are. They are all being integrated. So if that's the case, then when you sell a house, you don't sit there and say, well, okay, I built the stairs for you, so I'm gonna put the stairs in the contract. No, you're selling the house, and you went out and you had somebody do the stairs. So it's all basically one performance obligation. All right, these are just, I'm not going to go through every one of these people. There's just too much here, but I'm just giving you other examples. They're really into this also when you sell software licenses, you sell computer products and stuff. Are you selling multiple distinct products? Are you not selling distinct products? The handbook gives, look at all these. Again, I don't have time to go through each one of these. This is right out of the handbook. Look at all the different examples. Some of them are one performance obligation, and some of them are multiple performance obligations. Okay. So it's really two issues. If I'm selling, one or more, that's the main issue. And you also want to discuss if you're doing it today or if you're doing it over time. The over time is going to come up later in step number 4. So I'll deal with that. I'll deal with that in a few minutes. That gets into more detail. The main issue is identify your performance obligation, singular or plural. That is really step number 2. Any questions? Step number 2. Okay. Step number 3, which you might think is major. It could be major, I guess, but interestingly, it's not always, and so far it has not really come up as such a big step, is determine the transaction price. Now, there's about 5 different issues that they can get into here. They can get into no issue. But if you want to talk about how do I mess up the price, how do I give you an issue dealing with the price, here's 5 different issues. Okay, let's look at each of these briefly, okay, and I'll just show you. Again, they don't have to have an issue here. Variable consideration. You know what the question is? What happens if part of the price is not totally fixed? It's based on something. It's variable. It's based on a performance bonus. Discount, penalties, rebates, incentives. Check this out. Price concessions. I don't know. It's based on something. How do you recognize the revenue when the price is based on something? So there's different methods you can use. And here they're quite flexible. You can use something called an expected value method. I don't know. It's like a probability weighted method. You want to recognize revenue based on probability. Or you could do a different method, the most likely amount. Okay, that's another way to do it. Both are fine. The point is, there is some revenue coming in, and it's not 100% that I know exactly how much is going to come in. That's my problem. My problem is one of measurement. That's my problem. Measurement, how much? I'm not sure. It's based on performance bonus. It's based on an incentive. I don't know. Are they going to meet the incentive, not meet the incentive? So you're trying to figure it out. That's all. And you're using probability, estimation. Related to point A, look at point B. There could be something constraining estimates of variable consideration. All right, before I read it, let me ask you guys a question. What do you think the great fear is here? What are they worried about in any revenue recognition? What's the tendency? That's my question. What's the tendency?
Overestimating revenue.
Right, excellent. Overstatement revenue, beautiful. That's the tendency. So look at step B. With that in mind, please look at B. What do you think they tell you? You want to recognize variable consideration? Well, it's got to be highly probable. That is a higher bar. That is a higher bar. I don't usually need highly probable to recognize something. I can recognize payables and receivables when they're over 51%, if they're reasonable. I don't need highly probable. That is a higher bar. Why do you think they're doing that? Because the minute something is variable, they know it's open to manipulation. It's variable. I could play with it. And a lot of times they're worried about overestimation. Now, the truth is, not all the time. Be a little careful here. Definitely, they could give you a situation where I want to minimize my revenue. Okay, fine. But we all know that that's a minority. The majority is going to want to overstate their revenue. So if something is variable, make sure you clue in the bar is a little higher. It's got to be highly probable. Okay, they're putting this little constraint on. All right, how do you account for it? I'm just quickly showing you here. If the customer can return the product, and you expect this will happen, okay, well, that's not highly probable. I'm going to recognize revenue. Forget that. They're going to return the product. So, of course, don't recognize revenue. So what do? Okay, debit the asset to be returned. I expect it to be returned. Debit cost of sales, a credit inventory. And when I have to whatchamacallit and I'm returning the product, they're going to pay me back the money. Debit cash, credit, refund liability, credit revenue. So maybe I get to recognize some revenue, but I can't recognize the revenue up front. I got to wait till the product is returned. Okay. If it goes the other way, in other words, when the refund happens, okay, if they paid you money and now they're going to return the product and you still have some money, let's say, to give them, you debit the refund liability, credit cash. You know, I'm just going quickly through this. The only point here is that If something's going to be returned, it's not exactly highly probable. Okay, all right, and you can look at this as just basically, I'm just trying to show you how you would measure the different, how you would account for the different items on the financial statements if you have a sale with a right of return. That's fairly common. Okay, revenue, refund liability, asset as an expense. Okay, fine. Now, C is important. Nobody likes C. It's financing. People, here's the question. Do I have to discount? So there's one little out here, which is nice. There's one little out. Check out the out. By out, I mean if it's within a year that you're going to be paid, you do not discount. You don't have to discount. Typically, I guess you could, but you don't have to. The problem is if it's more than a year, you're supposed to discount. Okay, so please keep that in mind. Sometimes they give you long-term contracts. They're more than a year, and you're supposed to discount. Okay, and you determine the discount rate at the inception, whatever. Okay, but you do have one escape clause. If it's within a year, you can get out of it. Okay, 8-10 months, don't worry about it. There are a few other examples where you can get out of it. That's all I'm showing you here. Some of these are obvious. I'm not gonna read every single one, but look at this one. Like, it just as an example, just so you understand it. Future payments are not in the control of the customers or vendors. In other words, you're in control of the payment of when they pay you. So then you can get out of discounting because you can control it. But if you're not in control and it's more than a year, you're kind of dependent on them, they're paying you, then you're supposed to discount. All right, so these are just a few other ways to get out of it. Okay, fine. I will tell you, people, sorry, it's you're going to think this is really weird, but I just have to tell you this. They have not tested this yet. That's a good thing, because this is something people are going to find complicated. Everybody see the second last point on the slide? If the customer pays in advance, that's like an interest expense. I'm not getting into the journal entries with this. I don't think it's important enough, and the handbook does give more detail on this. But what gets very weird here, it's not intuitive. It's kind of the opposite you would think. Somebody paying you upfront, or not upfront, I guess upfront or whatever, somebody paying you earlier creates an interest expense. And the opposite is the last point. If they pay in arrears, it's recognized as interest income. It's like you're earning interest over time, so they're paying you later. So it's really the opposite of intuitive. It's kind of weird. They pay me sooner, that's an expense? Yeah, because you're not going to be recognizing interest income over time because they paid you sooner. So that kind of results in an expense when you do the journal entries. I'm not doing it here. I'll be honest, it's just not worth it, because I don't, it is more complicated. I'm just telling you the basic principle. Don't be surprised if you see this. It works kind of the opposite. I'm sure if I would ask the question, most of you would not have got this right if I would have said, what do you think it is, interest income or interest expense if you pay me sooner rather than later? Most of you would have said, oh, that's income. And that'd be wrong. No, that's recorded as interest expense. It's a very weird way of doing it. All right. A couple of other quick issues. Non-cash consideration. Okay, fine. This doesn't happen so much, but what happens if somebody pays you, you're selling something, and they're giving you a good in exchange? The key thing is you measure it at fair value. And if it's not reasonably estimable, you look at the standalone selling price. How much could I get if I sold that item in the marketplace? Let's just talk about how you value it. All right, and the last one, consideration payable to a customer, coupons, vouchers, I don't know, just different types of things that are built into the revenue if you give a coupon. So that's going to be a reduction in revenue. I give you a coupon. What's the problem? I don't know when you're going to use it. So you're going to say to me, big deal, it's a reduction in revenue. What else could it be? could be an expense. So all they're saying is, no, if it's a coupon, a voucher, that should be a reduction in revenue, not an expense. Okay, that's all. All right, people, that is step number 3. As I said before, none of those issues could come up. I don't know, like none of those issues may not come up. And then basically for step number 3, you would just identify the price. Any questions? Everyone good? All right, step number 4. Oh, question. Payment in advance may be to secure a discount on the sale price good. So not necessarily, yeah, okay, look. The payment in advance, again, that complexity about a payment in advance, people remember, I'm talking about situations that are going to extend over a year, number 1, because if it's not going to extend over a year, we don't have to worry about discounting. So if it is going to extend over a year and you're paying in advance, you're not paying 100% in advance. That's okay. That's, I think I would disagree a little bit with the comment. What if I'm only paying a portion in advance and I'm discounting because the remainder's coming over a year later? What I'm saying to you is you have to discount, and the payment in advance results in there being an interest expense. That's all I'm saying. Okay. All right. Step number 4 goes hand in hand with step number 2. One sec. Okay. Step number 4 goes hand in hand with step
I
number.
have one question here.
Yes.
Like in step 1, we said identify contract, and while identifying contract, I will see whether the purchase price is fixed or something. So why, I mean, I know that this is based on the handbook, but I mean, if the purchase price is already there in the step 1, we still have to identify in step 3, right? Separately to show that this is the price.
Yeah, it's a very good point. But, and the answer is, again, yeah, I mean, the answer is yes. I am telling you to do all the 5 steps. What you're saying is a lot of times the price will be kind of obvious. It's in the contract. So I just gave you 5 different issues where it's not obvious. So you could have, you could identify the contract, and then you have issues within the price, step number 3. That's all. So again, if there's no issues in step number 3, then step number 1 and step number 3 could be literally 2 sentences. Yes, I have a contract, and yes, the price is X, and there's no issue. That's all I'm saying. All I'm saying is there could be issues in both step number 1 and step number 3. It's not automatic. It's not automatic that step number 1, because there's no issue. I don't know if that's what you're saying, but it's not automatic because there's no issue in step number 1 that there's no issue in step number 3. I could have an issue in step number 3 and not an issue in step number 1.
But there is also a possibility that if there is no purchase price in the contract, for example,
No,
then
but
the step number.
yeah, but one second.
Step
When you say
1,
there's no, you say there's no purchase price. Yes, okay, one sec. But I didn't say there's no purchase price. I'm saying the purchase price could be variable. There is a purchase
okay.
price, but maybe it's based on something. That's not fair to say there's no purchase price. The purchase price is $3,000 plus 10% if X happens. So part
Okay.
of the purchase price is fixed, and then
Mhm.
there's a variable component. And maybe, by the way, maybe the variable component is minor. So step number 1 is a no-brainer. Yes, I got a contract. Yes, it's probable. I get $3,000 up front. That's 80% of the revenue. But there's a 20% variable component. So you have to deal with the 20% variable component in step number 3. But you have a contract. 80% is probable. We said as long as it's highly probable. Yes, 80% is probable. No, 80% is there, no problem. So there's no issue in step 1.
Okay.
You with me? Okay.
Yeah, got
All
it.
right.
Yeah.
Now, you guys can guess step number 4. Allocate the price to the performance obligation. Well, guess what? If you only have one performance obligation, this becomes pretty easy. The problem is, what if I have multiple performance obligations? Now I have to allocate the price. How do I allocate the price? Well, can you sell each performance obligation separately? Can you sell the product separately? How much? how much can you sell the product separately to person A versus person B? Okay. And step number 2, what if the answer to step number 1 is no, it's not obvious? I don't know how much I could sell it to A or to B. Okay, then we have to estimate. So how do we estimate? Well, this is pretty easy. Look at the simple example. You got A, B, and C. You're selling all 3 of them for you're selling all 3 of them for $1,200. But if I sell them separately, they're more. $400 for A, $600 for B, $500 for C. That's more than $1,200. That's $1,500. So how do you allocate? How much is A? How much is B? How much is C? I got 3 performance obligations here. Just prorate. That's all I'm doing here is prorate. So the 400 becomes 320. Okay, just prorate basically. 600 is 480, 500 is 400, whatever. All I'm doing is prorating here. Okay, because if I sell them all together. So people, this should be obvious. Why do I have to do this? Well, I don't know. You got 3 different products and you got to recognize revenue separately on each product. I got 3 performance obligations. Those are the facts. Okay, let's pretend I got 3 performance obligations in step number 2. So you can understand why this is obviously a necessary calculation. Now, the handbook says you can use different methods. You don't have to do it the way that I just said. Okay, I just did what's called the adjusted market assessment approach, like big deal, fancy name. You could do other stuff. I don't know. The truth is very flexible, very flexible. You could do something called the expected cost plus margin approach. Just estimate how much each individual product would sell plus a margin. You could do this one. Look at the 3rd point. If you're not sure, you could do something called a residual approach. Look at the last point. You will look at the last point. Oops, look at the last point here. That's interesting. You know what they don't want you to say? I have no idea. I can't do any method. It's too uncertain. You know why? That goes against what we said at the beginning. We said at the beginning, if revenue is so uncertain, then what are you doing? That's step number 1. You got a problem in your contract if revenue is so uncertain. So they're saying you got to use judgment. Come on. You got to use judgment. So of course it has to be reliably estimated. They don't even say that in the handbook because it's kind of obvious. Once I get through step number 1, you better be able to estimate it. If you say to me you can't estimate it, then what are you doing? That's the point. So this is actually very consistent with step number 1. If you give a discount, this is easy. If you give a discount, allocate it proportionally. Okay, very nice. All right. The last step. Recognize revenue when each performance obligation is satisfied. So this step, probably the most likely to get, this is kind of a lot of your qualitative discussion. So when do I recognize revenue? I've already mentioned this. It's a transfer of control. So they did move a little bit away from a risk and reward basis, but I say a little bit away because it's still here. People, look at these 5 points. These are huge. But this is a little bit different. Under IFRS, control is the key. And these are 5 major principles. So yes, risks and rewards is here. Please don't say to me, oh, there's no longer risks and rewards. That would be totally wrong. Of course, there's risks and rewards. But it's kind of mixed in with 4 other things. These are all important. So I would definitely know these 5 points. This will form a lot, if not all, of your discussion when you're talking about when does control pass. And people, it's a judgment call. So please don't say to me, I need all 5. Not true. I could have control passing and I don't have legal title. I don't have physical possession. It's a judgment call, but you're supposed to look at all of these points. All right, I'm going to talk about that in a minute. Consignment arrangements, you get into weird stuff. Bill and hold arrangements. These are exceptions, okay, to the 5 points. All right, now, I think I said step 4 before I meant step 5 when I talked about recognizing it today or over time. So that is a major issue. That is a major issue. Do I recognize today or do I recognize it over time? So they start to give you a lot of guidance. I don't know, number 1, when are you receiving the benefit? If I sell a widget, I guess I receive the benefit the day that I sell it. Or maybe I sell some service, that's over a year. Okay, provide cleaning services over the course of a year. Fine, so I recognize revenue over the year, over time. When does the other party get control? Okay, a building being built, they don't really have control of the building until it's finished. All right, is there an alternative use? Okay, fine, that one doesn't come up so much, but okay. So, and they give examples of what an alternative use is. All right, people, look. What would we call this under ASPE? Under IFRS, they say, you know what, you're going to recognize revenue maybe over time. You got to look at certain, you got to, whatchamacallit, consider what they call output or input methods. Let's say the answer is to look at recognizing revenue over time. On what basis will I recognize the revenue over time? Oh, maybe you should use machine hours. Maybe you should use labor hours. Maybe you should use how much time elapsed. It's been 3 months out of 12, I'll recognize 25%. I'll recognize based on costs incurred. ASPE refers to all of this that you guys are probably familiar with, called percentage of completion. IFRS does not really use that term, but that's what I'm getting at here. People should recognize all of this, compare it to ASPE. This is like percentage of completion. What do you base percentage of completion on? What's your basis? IFRS calls this input or output methods. Okay. And they also use something called the zero profit method. That's basically where you don't want to recognize any revenue until you've recovered all of your costs, and then you'll recognize the revenue. Like by revenue, I mean net income. Okay, both ASPE and IFRS have that. You'll see it afterwards in ASPE. So this is important. These methods are important. You use your judgment. This is how the handbook phrases it. Input or output methods if you're doing overtime. But that is an important issue. Okay. People, any questions? I know I'll have to break in the middle of this, but any questions? I think I'm hopefully still okay. All right, that was part, or A, that was A, the 5 steps. Obviously, that is critical, that is huge. Yes, it's come up. Not every step, as I keep saying so far, but I'd like you to go through all 5 steps. You can see there's issues they could throw in anywhere. Okay, any questions, people, before we get into B, which is a little less important? Okay, let's have a look at B. Surprisingly, the handbook for revenue recognition gets into the other side of the coin, costs, expense recognition. It's a little less important, but they give you some guidance. The major determinant here is whether or not I expense or whether or not I capitalize. So they talk about contract costs, and they try and give you some guidance on expense versus capitalizing. Why is that in this section? Because it goes hand in hand with the revenue rec. It's kind of the opposite side of the revenue recognition. It's the opposite side of the revenue recognition process. We may have some expenses involved. So it's kind of going hand in hand. There may be, for example, there may be incremental costs of obtaining a contract. That goes hand in hand. The revenue rec is dealing with the contract, but now there's some incremental costs. How do you account for the incremental costs? The truth is, a lot of this goes back to first principles. Expense versus capitalize. And if you capitalize, I may have to amortize. Not if it's less than a year. If it's less than a year, please don't amortize. It's expensive. Okay. So I put these into the notes. They give you some very nice flowcharts. Okay, they give you some very nice flowcharts. Should you capitalize or expense? I don't know. This stuff is pretty easy. I don't think this is so hard. You can kind of work through the flowchart. Would the cost be incurred regardless? Okay, so if you say yes, then you have to see, should I capitalize it? If you say no, the cost is only a result of the contract. So are you going to recover it? Well, if you say you're not going to recover the cost, how can you capitalize it? Of course, the answer is expense. But if you say, yes, I'm going to recover the cost, then you can capitalize it. Okay, you're going to cover the cost. There's a future benefit. People, I am literally going back to first principles. This section is not introducing a new way to discuss expense versus capitalize. It's only dealing with little things that could come up in the context of revenue rec, and it's literally using the same principles. Nothing I'm saying here contradicts anything with an expense. If there's no future benefit, if you're not going to recover, how the heck can you capitalize? Of course you cannot capitalize. Okay. All right, determine if other sections apply. Yeah, like obviously we have many other sections. Some we'll talk about today. We have many other sections like inventories, PPE, where you're gonna look to those sections to see whether you expense or capitalize. But if those sections don't apply, then you can capitalize under this section. That's all. All right, another little flow chart. Okay, about whether or not you have other sections or not have other sections. Okay, fine. It's not that important. People, look, again, I'm going quickly here because I think this is a little less important, but I do want to emphasize one point. It is not so uncommon for them to give you different costs or expenses, and you have to go in and you have to capitalize or expense different amounts.
I have one question.
Sorry?
What are the fulfillment costs?
Yes.
So I don't have any
I'm sorry.
idea.
You're asking a question. You're asking what are fulfillment costs?
Yes.
Oh, fulfillment costs just mean costs that would be necessary to fulfill the contract.
Okay, thank you.
That's all. All right. So we will look again. This is pretty simple. You guys can look at this example on your own. But I am saying just be careful, because the truth is, again, you may have to go cost by cost to figure out, do I expense or do I capitalize? But, you know, I don't look at this as any great insight, because quite frankly, you're going back to the same principles you go back to in the handbook on whether you expense or capitalize. That's all. Okay. I'm just giving you a little example here. Just look at this kind of on your own. Look at all these examples. Literally the handbook, they go a little crazy with us. This is all from the handbook. This is all from the handbook, different costs or whatever. So fine, quickly look at this. People, you don't have to memorize something like this. Okay, just understand the basic theory. Okay, just understand the basic theory and you should be fine. Okay. Interestingly, would you believe this section talks about impairment? It introduces a new impairment model for costs that are capitalized within the context of revenue recognition. People, we already have a section on impairment. Go watch the video. If you remember, I did the class with you on impairment for long-lived assets. We have a section for that. What do I need this for? Oh, this is maybe a different rule because this is talking about costs in the context of revenue recognition. Okay, fine. So you can look at this. I don't think this is so likely of coming up, but it's kind of interesting that they have their own rule here for impairment. Most of the time when I'm thinking of impairment, I'm thinking of the other section, impairment of long-lived assets. I'm not thinking of impairment in the context of something I capitalized in the context of revenue recognition. Okay, fine. And the apply impairment. Yeah. Now, obviously, by the way, first, you look to the other sections. You look to the other sections. Impairment guidance, like in inventory, long-lived assets, okay? You go to those sections first. But then, if none of those apply, okay, then you go to the IFRS section here, okay, fine. All right. And third, you go to a CGU. So what that means is if the asset is impaired, all I'm saying here is if the asset is impaired under this section, but you have a cash generating unit where you're combining assets, then you're going to use this section in your impairment, and the asset will get included in the CGU. That's all. It would still be included as impaired in the CGU. Okay, fine. All right. And yes, you can reverse the impairment loss. Okay, good. Reverse only up to the point you wrote it down. Fine. Okay. People, more importantly, that's it for part B. Okay. Almost done, but we're going to take a break soon. Okay. Let me just finish off at least the IFRS part. Okay. Other issues. So people, look, these are all in the handbook. There's a whole bunch of other little issues. Some of them are more popular than others. I will tell you which ones I think are more popular. Obviously, you should probably have some knowledge of all of them. I'm trying to summarize them here. Okay, let's go one by one. Again, I'm going to go fairly quickly. Stop me if you have any questions. But again, you can always watch back the video if I'm going too quickly. Okay, number one is gift cards. I don't think it's very popular. It's extremely specific. The question is, how do you recognize a gift card? Okay, fine. I don't care. Not so popular. Number two, more popular, warranties. This one has come up in the past, even before the IFRS section. You give a warranty. How do you recognize the performance obligation for the warranty? The question is the warranty distinct, separate from the product, or is it all combined? So you start to look at things like, I don't know, can you buy the warranty separately? Many times the answer is yes. Not all the time. Not all the time. And guess what? There's two types of warranties. You should definitely know this, people. This is already getting specific, but this is important. I don't think most people would know this. We never had this before the IFRS section. What the heck? Two types of warranties. Yeah, there's something called an assurance warranty, meaning you're giving the client assurance the product will function as it says it should function. That's an assurance warranty. Okay. You account for that like you do normal provisions, contingent liabilities. You're on the hook to provide the service over time to make sure it functions as it should. Or you could do a service type warranty. You're providing a service down the road. Okay. So if you get a warranty, first thing you do, classify the warranty into either number 1 or number 2. I'll give you one example. I sell a cherry picker. That's a machine that raises me up in the air in order for me to pick cherries. A cherry picker. Okay. It's got a 1-year standard warranty. You buy the cherry picker, I give you a warranty for 1 year automatically. But then I give you an option to purchase a 3-year additional warranty. This is a service type warranty. You don't have to buy the 3 years, but I'm giving it to you for $5,000. So that's a service type warranty. And I should account for it as a separate performance obligation. Why? Because it's pretty distinct. You don't have to give me that $5,000. If you want the warranty, you'll give me the $5,000. So I account for it separately. Okay, how do I account for it? I defer the revenue until the performance obligation is satisfied after 3 years. Check this out. You don't recognize it as revenue over 3 years. You don't recognize it over 3 years because I'm on the hook till the last day of 3 years. You could call me the last day of 3 years and I'll have to provide the service. That's why you paid me $5,000. Don't recognize it prematurely, please. Don't recognize it too early. You haven't performed the service. Are you going to? I don't know. The service is based on the passage of time, really. After 3 years, I'm off the hook. So wait till the end of 3 years. All right. Or how about this one? A luggage company. They provide a lifetime regular warranty on your luggage. Lifetime. Do they have to do this? No. There's no regulatory requirement. If the bag is damaged, they will fix it with no charge. Okay. Do they have to do it? No. No legal requirement. That suggests it's a separate performance obligation. They're giving you something they don't really have to give you. It's also longer. Do you think every luggage company offers a lifetime warranty? That suggests it's something over and above. A separate performance obligation. Okay. Who has control? Not really me. It's like, okay, well, one second, I have to be careful here. Promises beyond agreed upon specification. I don't control the product. People, you're using the luggage. Well, so what that means is, it's like, it's not really in my control. What's in my control is to sell you the luggage. But after that, if you go and take the luggage and throw it down the stairs and it breaks, guess what? I probably got to fix it. That's not really in my control. That sounds like a separate performance obligation. Okay. So in this case, guess what? It's a service warranty. You should account for it separately. All right. So people, this is important. This is, and by the way, everybody should understand, I'm going back to the same principles in my 5 steps. These are just extra issues that the handbook wants to give specific guidance on. But, you know, look what we're talking about here. Is it a separate performance obligation? This is step number 2. In some ways, it's step number 2. Is it one performance obligation? Is it separate performance obligations? And along comes the handbook and says, we're going to give you some additional guidance on these issues, on these other issues. Okay. All right.
I have one question.
Yes.
As you mentioned, in like there is no legal requirement or no legal obligation, but then there can be constructive obligation. So will
That's
answer
true.
be the same?
Yeah, no, that's very true. And 100%, 100% substance over form. And if there's a constructive obligation, there's no legal obligation, but you really kind of have to do it. Yes, I would account for it as a distinct. That's correct.
Yes. In that case, you are assuming the company is charging a price for.
That's correct. And you might have to break out the price, and that gets into step number 3. You might have to break out the price. You might have to break out the price and say, that's right, the company is charging something is built into the price of that luggage. And you know what? They probably are. That's right. So what would you do? I'd look at luggage that's comparable to another company that's not giving a lifetime warranty. I'm charging a little more. That extra difference is my price for the warranty. But you're correct. And that answers the question here. No additional price has to be paid. Right. So it might be. So yeah. So you'd have to see if there really is an additional price. The case could give you different, you know, could give you more information on that. Everybody else charges $150. I charge $200. Very comparable luggage. But I give a better warranty. I give out lifetime warranty. They don't.
Got it. Thank you.
But
You're welcome.
Ira, then in that case, when you say lifetime warranty, when would I recognize the revenue for the warranty?
Probably over time, and probably based on historical performance. Probably. I'd have to know the facts. You know what I mean? Like the truth is I could swing it. But that would be a logical way to do it. If you know that, you know, you sell luggage historically, and most of the time it breaks, I don't know, between 5 years and 10 years, you probably recognize more of it in those period, and after that less or whatever. You'd probably base it on historical performance, and you probably base it over time.
Okay, got it. Yeah.
Okay. You can have both. Okay, fine. So some of the stuff is obvious. Fine. All right. So number 2, very popular. Number 3, very popular. I don't know why, but they love this issue. It has come up in many cases.
I'm sorry. I have a question.
Yes.
If there is no additional price that has paid for a warranty over and above the cost of the item, do we have to analyze if there could be a built-in additional price, or
I mean, look, I mean, yes, you still have to analyze the warranty, but if there really is no additional price, don't start inventing like an additional price. No. You know what I mean? Like if you know right off the bat that there isn't, but you know, it's a bit of a weird situation that there's no additional price, right? Usually you charge for some value that you're giving. So that is kind of a weird scenario. You know what I mean? It is kind
For
of a
instance, if there are companies that give like 10-year warranties on luggages and stuff like that.
yeah, and if it's
but
all
they-
built in, okay, no, so it may not be, okay, so I agree with you. So it may not be distinct. It may not be distinct, and you just have to figure out what type of warranty is it, assurance or service, and then how should you recognize the revenue on the whole product? It's all built, in other words, it's all built into the 10 years. Okay, so there's no distinct price. Okay, so you're giving a warranty. You still could identify what type of warranty, but you could say to me that that's all built into the price. And you're saying to me that they're really not charging. It's a little weird, but you're not charging anything extra for it. Fine. So you'd still discuss it in the context of step number 3, in the context of the price.
Actually, they may not provide you directly that this is what they are charging for warranty, but
No.
they may give you some details on like competitors are charging this price and
Exactly. They give you hints. Exactly. They give you hints. Yep. All right. People, principal versus agent, you must know number 3. They have tested this in many cases. It applies. The good news here for number 3, it is both IFRS and ASPE. It is very similar. It is very similar. The terminology might be a tiny bit different, but it really is not a big deal. You can really have one discussion for both. The question is, look at the second bullet point. Are you the principal and you record revenue on a gross basis, credit revenue? Or are you the agent and you record revenue on a net basis? So you have revenue and cost of goods sold and the income falls out. The issue here is when I'm selling a product, do I record $100 in my revenue gross? Or do I record $150 gross and $50 expense, and the 100 is my income? Either way, the income is the same. Principal means you record the gross, just the 100. Kind of like, you know, agent says, no, I'm recording it on the net. I'm recording it, sorry, just I said that wrong, sorry. Principal means I'm recording it on the gross basis and I will have a cost of goods sold. Net means no, it's like a commission. You'll see in a second, it's like a commission. I'm just recording the bottom line. How do you know which to do? It's based on some principles. You have to kind of discuss this pros and cons. You have to have significant judgment. So people, look, I'll give you a real life example. Okay, I'll give you a real life example. When I was in public accounting, I had a client, and in Canada, they were a distributor and they had the right to distribute Heinz ketchup. Now, what does that mean? They had no warehouse. What they did is they had a bunch of offices. That's it. They had a bunch of offices in a building, and they negotiated with Heinz that they took control of the product from the second it left the Heinz warehouse. This is, my client was not Heinz ketchup, but they had to deal with Heinz to deliver the product from their warehouse onto the supermarket floor. Okay, so the question came up, how do we recognize their revenue? What is their revenue? Two choices. Do they recognize revenue on the basis of every bottle of ketchup that you know, they mark it up or whatever, they have a markup? So they recognize the gross revenue minus the expense of the bottle of ketchup, and they end up getting 5 cents. That's the, you know, at the bottom, that's their income. Or do they just recognize the 5 cents? Are they more like they're earning a commission on every bottle of ketchup, they get 5 cents? Or is it more like gross, where, you know, they recognize revenue in the bottle of ketchup that they take control of minus the cost of goods sold? That would be gross. And we ended up saying net. We said they're more like commission because they have no inventory risk. They didn't even have a warehouse. They didn't have a warehouse. All they were doing was taking control of the product, and it's on the highway. I don't know, it's being delivered in a truck to go to the supermarket. Did they have discretion in selling prices? No. No. Heinz did. They were just moving it from A to B. That implies that they didn't really have control. They were just earning a percentage, like a commission. That's net. People, that's the issue. It's the same issue. Okay. Oh, people are talking about here. Oh, principal versus agents and travel agency. Yeah, the travel agency, very good. Yeah, this applies in different things. Anyway, the bottom line is it is an important issue. It's come up a lot over time. You just have to go back to these principles. That's it. Okay. All right. Now I can go quicker. I have to go quicker. All right. Non-refundable upfront fees. Okay, so this is typical. I don't know, when you join a health club. When you join a health club, you pay a fee up front. How does a health club recognize that fee? Okay, it's not refundable. It's not refundable. So again, we're going back to the same principles. I don't know, you follow the 5-step model. The upfront fee, we're going to talk about this in a second, is going to be a material right. Does the health club have to provide a service for the fee down the road? Not really. I got to pay a non-refundable fee when I join. So then they can probably recognize the revenue up front. Okay. But what if the fee relates to the services they're providing? What happens if the health club would close a month from now? Would they have to refund that fee? Let's say yes. Okay, and they should recognize it over time. Okay, so non-refundable fee up front. Now, number 5, I've never seen this one come up. It's kind of unique to the IFRS section. They talk about recognizing a material right. This ties in to separate performance obligations. A material right, it gets into things like sales incentives, that the customer can acquire additional goods or services for a discount or for free. They have a right. They have a material right, okay? Were it not for the contract, they wouldn't get it. So the question is, how do you account for this? The real answer is you probably just incorporate it into the 5 steps. But they just use this language, it's a material right. You have an option for an additional good or service, it's material. So the question is how to account for the revenue for the material right. It just goes back a lot to the basic principles we talked about before. Okay, how do you account for it? Over time, prospectively, with a cumulative catch-up, whatever, I don't know. Does it relate to something in the past? Coupons? Is that part of their marketing effort? Is that a material right? So a lot of times it's not even material if you're talking about coupons, or maybe it is material. Often they're not redeemed. You should probably recognize some of it if you know they're not gonna, if you're not gonna always be redeemed. It has to be material. People, look at the third point. It's got to be material. Otherwise, don't even get into this whole issue. Would probably, you know, then it's not really a material right. Okay, then if it's not material, you just recognize it when they use it. It's a reduction of revenue. I said that before. All right, customer loyalty programs. People, just to finish off the IFRS, customer loyalty programs, that's pretty specific. It is kind of a hot topic. I'd say it's kind of an interesting topic. How do you recognize that? You can look at it, you can crunch through the numbers. You know, we have many, many loyalty programs out there, right? Where you earn airline points, you earn lots of stuff. You buy something from a customer, you buy something, you buy a product, and as part of the product, you're getting some, I don't know, you're getting some points towards a loyalty program. So the question is, how do you recognize a loyalty program? So the point is, usually, if it's significant, which usually it probably is, you have to recognize it as a standalone selling price of the loyalty points. What's it based on? The likelihood of redemption. As we know, they're not always redeemed. So the handbook gives examples I'm not going to go through the examples now. You guys can look at the examples. Okay, I'm giving you journal entries and everything. It comes right out of the handbook section. So I'm not going to say this is really popular. It has not really come up very much that I can think of. It's obviously very specific, but in real life, it definitely is popular. So you just want to be prepared. If something like this comes up, they start to give you ways of how you would actually do the calculation. So just follow my example. Again, I don't know if I have to go through it. I think it's pretty understandable if you just read through it. Okay, renewal options. Yeah, I don't know, not so whatchamacallit. This gets into a material right. If there's a renewal option, look at the bottom. If there's a renewal option, provides a material right, and usually the revenue gets deferred to a future period. The whole point is, can I distinguish the renewal option from other options? Do I break it out? If I can't break it out, then there's no issue. Okay, this is also very specific. They're really into these licenses, computer technology, intellectual property. So the issue is, do I look at this as part and parcel of what I'm selling? Or is this a separate, almost like, again, a material right? Is this something separate that they're buying? The license, do I account for the license separately? Is it a separate performance obligation? Again, you're going back to some of the 5 steps. Okay, is it a material right? When do you recognize the revenue? Do I recognize the revenue over time? Do I recognize the revenue at a point in time? So they give you guidance on intellectual property. Okay. This one has been tested. This is kind of, I don't know, popular. It's not as big as gross versus net, but bill and hold have come up. People, what is bill and hold? Bill and hold is I'm not delivering the product, but I want to recognize the revenue. Well, guess what? This contradicts one of the points in step number 5. Delivery. I thought delivery is so important. The answer is it is important. Delivery is important, but there's a special type of arrangement. I have not delivered the product and I'd like to recognize the revenue. Why can I recognize the revenue? Because I'm going to meet certain criteria. I'm going to meet certain criteria, and you can see these points. In order to recognize revenue, the key is control. One of the points involved in step number 5 is the physical movement of the goods. That is one of the 5 points. That indicates control. But maybe I don't have that, and I still want to recognize revenue. Okay, so you got to have other points. And you guys are not reading each one, and you can read these other points. Here's a little, I think I have a chart. Check out the chart. Okay, so people, look, it's pretty specific. It has been tested. Just be familiar a little bit, you know what I mean, with these points. And the reason why does this get discussed separately? It gets discussed separately because it's kind of an exception to the rule. Because normally I would be physically transferring the good. And then I recognize revenue. But in this case, I can recognize revenue even though I did not transfer the good. I meet enough of the revenue recognition criteria to say that I transfer control. All right, repurchase agreements, not very popular, whatever. I don't even think I've ever seen this come up. Again, this gets much more complicated into call options, put options, forwards. Okay, how do you account for that? The handbook actually gives a lot of guidance on this. I've even given you guidance here. I'm giving you some charts. You can look at these. You can look at some of these charts. This is not what I consider to be very important. Okay, this is very specific. Obviously, they could test it. I'm not telling you they couldn't test it. I have it in the notes. I'm just telling you honestly, as it really come up in the past, the answer is no. They just give a lot of detail on this, how you account for call and put options. Okay, so I don't want to waste time covering it because, again, I don't think it's so popular. Consignment, number 11, is actually more popular. Yeah, this would come up. This is nothing new. They've tested this over the years. Consignment means I don't recognize revenue until the product is actually sold. So I give the product to you. You're holding the product. You're trying to sell it. The product is no longer in my warehouse. Oh, I delivered it. Maybe I should recognize revenue. Well, wait 1 second. I can't really recognize revenue until you sell it. So I better not recognize revenue. That's called a consignment arrangement. Okay, that's come up. Again, going back to the same principles. When do you recognize revenue? All right, so I don't know, who's got control? If they have control, meaning they're the ones selling it and they didn't sell it, I don't recognize revenue now. I have to wait. Okay, contract modifications, basically you're changing the purchase price, you're changing the transaction price after time. How do you account for contract modifications? Okay, the issue here, is it like a separate distinct item, like a separate performance obligation? Or is it all tied in together? Is it a separate contract or is it all tied in together? And they give you different conditions here. Again, not so important. Okay, and you just apply the 5-step model, whatever. Again, we go back to the same principles. All right, so people, look, I tried to show you which ones are more important, which ones are less important, but you know, some of those definitely have been tested in the other issues. The good news is, you'll notice I did not really introduce new revenue rec principles. You really go back to the 5 steps, but these are exceptions. These are things that, I don't know, they kind of broke out in the handbook section. All right, and lastly, to finish this off, and then I think we should take a break, presentation and disclosure, not so important as it is not important for almost any topic. Okay, on this exam, you have the handbook, it's open book, so there's lots of guidance on presentation and disclosure, and I'm not going to get into this. Okay, there's different things you can look at here. No, I don't think it's so important. All right, so people, 2 more things, 2 more little points, and we're going to break. I tried to summarize the material to make it a little easier for you. This is my quick summary. This is my quick summary. The 5 steps, key things within each step. Okay, that's my first thing. Contract costs, other issues. I just listed the other issues, trying to basically give you a very, very quick summary to make sure you're familiar. This is just one of the things you can look at after you study the section and you feel comfortable with the section. You can go back and make sure you know it. Just go back to this summary. Now, people, look. One of the things people do on this exam is they quote handbook paragraphs. They copy and paste the handbook paragraph. You don't have to do this. As long as you can say it in your own words, no problem. What I did is, but a lot of people don't want to memorize everything. So they go back to they go back into the handbook while they're writing the exam and they copy and paste the paragraphs. So I tried to come up with what I think are popular paragraphs that you may want to go back to in your revenue rec discussion. Some of these have already come up in cases. So some of these are important. And yes, they tie into the 5 steps, but don't blame me. Check, the order is really weird. I tried to show you. You know, identifying a contract is paragraph number 9. Okay. Satisfaction of performance obligation, step number 5 is paragraph 31. But when you're dealing with the transaction price and they give you guidance how to recognize the price, we talked about that in step number 3, that's paragraph 46, 47. As I said to you, they're all over the place. Don't blame me. Okay, I can't help it. This is the way they put together the handbook section. Yes, they're all here. Of course, they're all here. I've got step 1, 2, 3, 4, 5. Everybody see that? Step 1, 2, 5, 3, 4. And then I've got other paragraphs. So this I'm hoping will help you, because this will just, you don't have to memorize these. But if you're the type of person that's not going to memorize stuff and you want to go into the handbook and copy and paste them, beautiful. Okay, here are the paragraphs. Here are key paragraphs. That's all. And then they have appendices, Appendix B, Appendix C. Check this out. Okay, if you didn't believe me how crazy this is, there's only 63 examples. People, please don't learn 63 examples. Like, is that nuts? 63 examples that the handbook gives across the section. So when I said this is a massive section, which is why it's taken me close to an hour and a half to go through, That is the reason, okay, it takes me this long. I will not be spending this amount of time, don't worry, on the ASPE section, which is 1,000 times shorter, okay, or investment property and PPE. This is just a massive section. It is what it is. Okay, people, let's take a break. Let's take a 10-minute break. Okay, I don't know. I've got, okay, I don't know what time it is for you. Okay, whatever the time is for you, please take 10 minutes. Okay, we have different people in different time zones here. Please take 10 minutes, come back in 10 minutes. We will continue. I will put a pause on the recording. Okay, so I think what I'll do is, that concludes the recording. That concludes the recording for the IFRS section for revenue recognition, which I hope everyone found useful. And there will be a separate recording for ASPE when we talk about ASPE for revenue recognition. Okay, so this concludes the recording for IFRS.
I hope you liked the video excerpt that you just watched. If you're interested in acquiring the CFE technical binder that PASS puts out along with the technical videos, I would ask you to visit our website. Please put your cursor over CP module resources, which you'll see at the top of the screen when you get to the home page of the PASS website, and then click on technical resources for the CP. You can then scroll down and order the binder plus videos online. Once you're on our website, you may also want to take a look at an excerpt from the binder itself, which you can purchase in either hard copy or soft copy. The PASS website also describes the live technical and case writing courses available at PASS. If you'd like to learn more about our live courses, I would ask you to put your cursor over CP module courses, and you will see a drop down, and you can then click on the course that you may be interested in. In case you'd like further information on either the CP binder plus videos or any of the courses offered by PASS, I'd be delighted to speak with you. You can contact me, Michael Levy, and you see my contact information here. Please also feel welcome to contact my partner, Ira Walfish. I wish you all a good day.